South Africa, where local media is reporting that a high-level meeting involving top banking executives and the country's finance minister over potential U.S. sanctions is taking place, or rather took place. Now, Sowetan, which is a daily newspaper, said that their conversation focused on an American bill that, of course, is targeting African National Congress leaders over South Africa's ties with Russia and China.
The global financial system just felt a shockwave, one powerful enough to rewrite the rules of money itself. South Africa has broken from the US-influenced banking network and is building a payment system unlike anything the continent has seen. Overnight, banks, governments, and financial giants worldwide went on alert. Some call it a bold leap toward African independence. Others fear it could fracture the balance of global power. But one thing is clear. This move isn't just about payments. It's about who controls the future of global finance, and the world is watching every second.
South Africa's financial sector has ignited a global storm, unleashing a wave of reactions from capitals, companies, and institutions across every continent. The announcement that the country is building a national and regionally integrated payment network free from U.S. influence banking pipelines has hit the global system like a sudden jolt of electricity. It is not simply a financial initiative. It is a geopolitical event unfolding in real time. For decades, the United States has dominated global payment traffic through its institutions, channels, and oversight mechanisms. The stability of that dominance, long taken for granted, is now being openly challenged inside Africa's most industrialized economy. At the very moment South Africa declared that it would carve its own path, financial analysts realized this was not a local modernization plan, but a direct political message reverberating through the arteries of global trade. Banks, central institutions, and multinational companies swiftly recognized that a tectonic plate beneath the international monetary landscape had just shifted in full public view. South Africa's aim is not secrecy. It is transparency and autonomy. The proposed payment network is designed to manage domestic transfers, cross-border transactions within Africa, and commercial settlements with international partners, but without relying on channels historically guided by the U.S. financial architecture. In practical terms, this move rewires how money flows, who controls the switches, and what geopolitical pressures can or cannot be applied. The country's economic ministries emphasize that the system is engineered to increase resilience, reduce dependency, and amplify African financial sovereignty. What shocks the world is how openly this initiative challenges the long-standing hierarchies shaped by systems such as SWIFT, U.S. regulated correspondent banking, and the informal diplomatic leverage that has accompanied them for decades. South Africa's message is unmistakable. Financial power in the 21st century will not remain unipolar. Reactions from global institutions came quickly. U.S.-based financial networks expressed concerns about potential risks to transparency and uniformity, yet analysts noted that their language carried undertones of strategic anxiety. European institutions were more measured, observing that alternative payment ecosystems could diversify global risk but also fragment compliance norms and reporting channels. Asian financial hubs reacted with curiosity and strategic interest, seeing opportunities for partnerships that bypass traditional bottlenecks. Meanwhile, African regional banks and fintech companies greeted the announcement with overwhelming enthusiasm. For them, the idea of an African-led payment infrastructure symbolizes independence, modernization, and economic dignity. Many have argued that African markets have been held back for decades by systems that impose high costs, slow approvals, and external oversight. Now a major African power is offering a blueprint to break free. The United States, however, views the development through a security and influence lens. Payment systems are not simply technical, they are geopolitical tools. The structure of global finance allows countries to enforce sanctions, regulate trade flows, investigate illicit transactions, and shape the economic environment of entire regions. When a nation as large and interconnected as South Africa decides to create a parallel ecosystem, it signals a broader ideological shift. The concern is not that South Africa is forming a payment system. Many countries have their own national networks. The concern is that the initiative is explicitly designed to reduce reliance on U.S. link channels, and encourage other African economies to join. The prospect of a continental financial corridor outside Washington's sphere of influence raises questions about enforcement power, global standards, and the future of monetary governance. It introduces the possibility of multiple competing systems rather than a single dominant one. African nations, long constrained by international transaction delays and elevated fees, are now studying South Africa's model with remarkable urgency. Several regional blocs, including those focused on trade integration, have expressed the intention to explore interoperability with the proposed system. For emerging markets across the continent, the appeal is straightforward: a payment network built inside Africa, priced for African economies, and shielded from external political conditions. If realized at scale, South Africa's system could trigger the most significant internal continental economic transformation since the rise of large free trade agreements. It would enable faster settlement of intra-African commerce, reduce reliance on foreign correspondent banks, and empower African companies to operate with unprecedented fluidity. Such a shift could redefine supply chains, banking models, and competitive strategies for decades. The global financial community acknowledges that the timing is strategic. The world economy is undergoing intense realignments, with major powers strengthening regional currencies, establishing independent clearing systems, and recalibrating their positions in the international order. South Africa has seized this moment to assert leadership. The decision signals confidence in its institutional strength, its technological capability, and its diplomatic leverage. It also reflects growing frustration with the vulnerabilities that come from operating inside a system where key levers can be influenced from abroad. The last decade has demonstrated that financial networks can be weaponized during geopolitical disputes. That realization has spurred many countries to invest heavily in alternatives. Now, Africa joins that wave, not as a follower, but as a pioneer crafting a model tailored to its economic realities. Financial companies around the world are now recalculating the risks and opportunities involved. Some multinational firms fear increased compliance complexity as they may need to adapt to a system with different standards and protocols. Others see a lucrative chance to integrate early and establish dominance in a new financial frontier. Global payment processors, digital wallet companies, and banking software developers are already assessing the infrastructure needed to connect with South Africa's initiative. If the system proves scalable, they anticipate that a broader African integration could follow. For technology providers, this is not merely a change in routing. It is a structural transformation of the market itself. A continent of more than 1 billion people, with rising digital adoption and youthful demographics, presents an economic opening too significant to ignore. While the shift carries promise, it also generates caution. Critics warn that creating a new payment architecture demands ironclad security, absolute reliability, and strong governance. They argue that fragmentation could complicate oversight and enable inconsistencies in monitoring financial crime. Supporters respond that technological advances allow for systems that are both independent and compliant, using modern encryption, real-time reporting, and standardized verification protocols. South Africa has emphasized that its new network will not operate in financial isolation. Instead, it aims to align with international standards while retaining regional autonomy. The difference lies in who sets the rules, who monitors the transactions, and who controls the infrastructure itself. For many African policymakers, that distinction marks the line between dependency and sovereignty. The ripple effects across global politics are equally significant. Countries that have sought stronger financial independence from dominant systems view South Africa's move as validation of their own strategic direction. Regions investing in alternative digital currencies and national payment channels see a potential partner that shares similar motivations. Economic alliances may strengthen around shared goals of decentralizing global finance. Even countries aligned with U.S. financial institutions recognize the importance of adapting to more distributed architectures. The global monetary environment is moving toward multi-node connectivity rather than single-point control. South Africa's decision accelerates that movement and accelerates debates surrounding the future of reserve currencies, regional payment corridors, and financial governance frameworks. African markets stand to undergo a fundamental transformation. Businesses operating across borders could experience faster settlement times, more predictable liquidity, and lower operational costs. Government agencies may gain greater control over monetary flows, facilitating better planning and economic coordination. Local banks could expand services without relying heavily on foreign intermediaries. The entire region could see an increase in trade volume as transactional barriers fall. As velocity increases, investment patterns may shift, with more capital circulating within the continent rather than flowing out through external payment networks. This internalization of financial activity could stimulate manufacturing, enhance agricultural competitiveness, and strengthen digital commerce ecosystems. In short, South Africa's initiative could serve as a catalyst for stronger regional integration and long-term economic resilience. Globally, the financial reaction reveals a mixture of apprehension, curiosity, and strategic repositioning. Institutions that have long benefited from centralized control now must anticipate a world with multiple independent channels. Some analysts predict a gradual decline in the dominance of single-country financial infrastructures as countries and regions pursue customized models that reflect their diplomatic and economic priorities. The rise of diversified payment networks could lead to a more balanced global system, one where influence is distributed rather than concentrated. South Africa's decision fits within a broader trend but stands out because of the clarity of its intention and the scale of its potential impact. The international community is not simply watching a new financial tool emerge. It is witnessing an ideological declaration with global consequences. This moment will be studied by economists, policymakers, and historians as a turning point in the evolution of global finance. South Africa has forced the world to confront a fundamental question. Should the architecture of international payments remain under the influence of a few dominant powers, or should regions build systems that reflect their own priorities and protect their own interests? The answer to that question will shape the future of global commerce, define the balance of power, and determine the rules that govern the movement of money across borders. The world is now entering a period of accelerated competition, innovation, and restructuring. South Africa's payment revolution is not the final destination. It is the opening sprint in a race that will redefine financial sovereignty in the decades ahead.